right. Well, you know that this has been called the Great Recession, not the Great Depression yet, and we want to know the implications for luck. Usually the first question is how you characterize the recessions. Hurricanes and earthquakes are all bad, but each one is bad in its own way. So how you organize the thinking about this bad thing, which is a recession. And we economists have a little bit of impaired imagination, so we need from time to time people that tells us, some story that we understand. And Ragnar Frisch in 1933, we were, the economist profession was grappling with this idea of business cycle and so on and so forth. And he said, well, this is like a rocking horse. One thing is if you hit a rocking horse with a club, one thing is the club, and the other thing is the rocking of the rocking horse. So we economists say, oh, that's fantastic, because we have then impulse and propagation. Of course, as a lot of the images in economics is also flawed, because in fact the impulse and the propagation system, they're linked, in which case you need to look at the origin and size of the shocks and the channels of transmissions, but also the conditions in the economy, and they very much are sometimes related. Conditions meaning structural conditions and policy response. In the case of Latin America, then you have an impact on the economy, on agriculture and the poor, that I'm going to comment also briefly. And to do that exercise, we have also examples here. You can take a historical view, how were the previous recession look like and what the impact was, or do simulations and projections going forward. And we had examples of both. In the case of agriculture, if you look at the issues of structure, it's important to differentiate by tradability, what are the main markets, source of inputs. For instance, in the Asian crisis in the 1997, exportables benefited from the crisis, while high income like livestock in Korea that depended on soybean imports from abroad, the devaluation was a big hit on the income side and the cost side. So it very much depends on the agricultural sector as a whole, as you saw, and I will show it also for Latin America, usually tend to fare better under a recession, but still may even not get into a recession, even though the whole economy is going down, the GDP is declining. So it depends very much on whether it's an export, it's a high income elasticity, depending on imported inputs or not, and also how the recession looks in terms of do we have a banking crisis, yes or not. That's very important to have a credit crunch or not having a credit crunch, and if we have also a fiscal crisis or not related to a recession. In case of poverty, and when I was in my happy time here at IFPRI, we always did all the models with unemployment, because usually sometimes the poverty impacts are looked at prices and wages. But a key additional quantity variable, not price variable, is employment. So you need to look at employment, wages and incomes, the price of food and other items, and of course the government service and safety nets, how they are impacted by the crisis. So if you look, then what is the possible historical comparison for this crisis? Of course, everybody goes back to the Great Depression, but the other one is 1982-83. Of course, the Great Depression, with the economists are still fighting, what exactly happened there. But it certainly was very bad, but at the same time, the economists at that time didn't have services. It were basically goods, and therefore agriculture and industry were hit very, very hard. So it's not necessarily a very good comparison. The only thing that I take from that discussion is there was an implicitly coordinated monetary and fiscal contractionary policy at the world level linked to the gold standard and the fiscal conservative vision that, how you run a balanced budget in the public sector. So there was a specific macroeconomic impulse there that I'm going to go back later. Then, okay, let's go back to normal times for which we have national economic accounts. This is the growth, the global growth since 1960 to 2009. So we have the mid-70s recession, the early 80s, early 90s, early 2000, and the coming one. This is a little bit outdated because the little red line going down should be going down a little bit further. But the main point is, no, it's not very much, a little bit. So the basic point of comparison is 1982. That was the global growth at that time was almost close to zero, and so therefore that's a good point of comparison for this period. Okay, what happened in Latin America? but first the origin. The origin was, in the case of the Great Depression, was a implicitly coordinated tight monetary policy. In the case of the 1980s, was an explicitly coordinated, a policy decision by different countries that decided to combat inflation. Say, you increase interest rates, the nominal went over 15%, real went 6 or 7 points in real terms over previous levels. So basically, you had this monetary crunch in 1980s. Now, you do have a totally different mechanism. So if you want, and I don't have time to get into that, but basically you had for 15 years an expansionary monetary policy coordinated by also some implicit conditions that led to an increase in leveraging, and now it's an endogenous deleveraging. So in the previous one was an implicit policy decision. Now, in the 80s, was an explicit policy decision. Now, it's an endogenous response from the system, which means that policy is fighting that endogenous decision, and therefore it may take longer to compensate for. And this is related to the increase in leverage. I don't have time to go into detail, but the green line is the leveraging in the financial sector since 1987 to practically now. So a lot of, and this is in the systemically important developed countries. So basically, you have an increase in leveraging. People took too much debt, financial system, households, etc. Now you are deleveraging, and that's an endogenous response. Policy is fighting that, but that's going to continue anyway. And that was also related to this is from 1920 to close to now. The red line, which is is SP 500 in real terms, so you can see the two big bubbles, and you can see the green line is the household bubble. So therefore, you had a credit expansion leveraging that was correlated to this, of course, created the asset bubble, and now we are getting from out of that. So we have completely two different mechanisms, 1980s and now. And also, that's the shock, the impact, the club hitting the wooden rocking horse. But also, LAC had greater vulnerabilities in 1980s, larger current accounts and fiscal deficit, more rigid exchange rate, larger currency mismatches in banking system. So the banking system, the economy was dollarized, or more dollarized than now. Now the dollar level has been, of the debt, the percentage of dollar debt has been decreasing. There were less open economies and low levels of reserves in central banks. So again, not time to go into the details of how these things interacted, but basically the crisis was a multidimensional one. You had an economic crisis, a currency crisis, a banking crisis, a fiscal crisis, and a debt crisis, all together in the 1980s. What happened in Latin America? Okay, growth total in 1982-83 at the world level was 1.6. This is not per capita, this is total. And developing was 2, but Latin America was minus 1.8. In agriculture, the same pattern that Usman was referring to, usually is hit less than the rest. And in fact, in the rest of the world, in any case, in all the cases, agricultural grew faster than the comparative or total growth rate. In the case of Latin America, still there was a decline, but it was minor. Poverty increased from 24.6 in 1981 to almost 28, while in the rest of the world, the 1982 recession, which was the strongest up to now, in fact, poverty kept on, in the rest of the developing world, poverty kept on decreasing. So now, okay, this is the past, now the future. These are the growth rates. The red line is 0, so anything below the red line is negative. The blue line is advanced economies, the green line is Latin America, and the black line are the rest, all the emerging and developing economies. So you can see that in the first recession, 1982, Latin America had 82 and 83 of negative growth, and it was more as we saw from the previous table, it was negative compared to the rest of the world. That was very low, but not negative as a whole. But now, advanced economies will go lower than Latin America, will pull down Latin America and also the rest of, the totality of the emerging markets, but not as much as Latin America. But still, the projections of the IMF for Latin America are better than the realization of growth in 1982. So it will be a bad recession, but they are thinking, and by the way, the projections by the World Bank are a little bit better than the IMF on this regard. So basically, they're saying, okay, this is going to be bad, but perhaps not as bad as in 1982 for Latin America. Why? Well, we are better prepared. Well, I think we think so. Yet the external shock is bigger on several dimensions. We have a better policy reaction. We could do a smooth evaluation, somewhat expansionary monetary and fiscal policy, no banking crisis so far. And we have also the support from the G20 process. There has been a smooth adjustment in exchange rates. As I said, no banking crisis on fiscal crisis, better safety net programs, Progresa, and these type of programs were implemented in Latin America. Therefore, you could also expect a better performance than in 1982 for agriculture and poverty. The main issue there is what I call the blue projections. It's going to be a V recession, an L recession, or a U recession. And with this I finish. There are two projections that have been done by some people at the IDB. Two possible projections of if we have a V recession, which is the green line, that means that you go down, but immediately you recover by 2010. You are back where you were before the decline in real growth. But if we have an more like an L incline recession, that meaning that at the world level there's going to be 2 years of very negative and low growth, and then the increase is going to be, or the recovery is going to be slower, then the projection for GDP in Latin America means that the total GDP will not recover until 2013. Of course, this will have implications for fiscal, banking, and poverty safety net. So basically, as someone said, and Joaquim asked Maximo, I think, or no, Usman, and I reminded me of Yogi Berra, that he said making predictions is always very difficult, particularly about the future. Thank you.